When silver tagged $121, it wasn't just a high price. It was a stress test, a red line moment where the math started to look incompatible with business as usual. And then, almost instantly, 121 became $103. People called it a correction. But if you understand how futures plumbing works, you know something else can happen at the red line. A system protects itself. Welcome back. Today we're unpacking the $121 red line theory. Without politics, without slogans, just mechanics, incentives, and numbers. Important, I'm not claiming a secret meeting you can't prove. I'm describing how exchange risk controls, margin mechanics, and delivery incentives can combine to create a sudden air pocket when the market gets too close to physical constraints. Let's do the math. The math of the red line. In a futures market, open interest is the number of contracts still alive. Each contract represents a quantity of silver. So the paper market can represent hundreds of millions of ounces, while the deliverable pile in the vault is much smaller. Two key buckets matter: registered inventory, metal tagged and ready for delivery. Everything else, metal that exists but is not committed to delivery. Here's the red line setup you're pointing at. Registered inventory, roughly 30 million ounces. March open interest exposure, over 500 million ounces of paper claims. That's not automatically a default. Most contracts are closed or rolled before delivery, but it becomes a problem when holders start thinking, no, I want the metal. Now the trigger. If even 20% of contract holders decide to stand for delivery, that's about 100 million ounces demanded. And 100 million is more than 3x the 30 million available in registered. That's the moment the ratio stops being a headline and becomes a hazard, because the exchange and clearing members must manage two risks at once. Delivery risk. Can enough metal appear at the right time? Financial risk. What happens if the price spikes while shorts scramble? At $121, the total dollar value tied to potential delivery obligations explodes. It's not just expensive silver. It's the collateral and guarantee system getting stretched. When that stretch gets too tight, the market doesn't need a villain, it needs a lever. The two levers that can create a reset: lever 1, margin hikes. Margins are the good faith deposits traders post to hold positions. When volatility rises, the exchange can raise margin requirements. Mechanically, that does one brutal thing. It forces the most leveraged longs to sell right now because they can't post extra collateral on demand. Even if they were right long term, even if the fundamentals are tightening, they get liquidated because the rules changed mid-storm. So a margin hike can turn a crowded long trade into an avalanche. Not because everyone changed their mind, because they ran out of time. Lever 2. The cash settlement shadow. Most people believe futures equals guaranteed delivery, but rulebooks often contain provisions that allow alternative settlement under certain conditions. You don't need a headline announcement for it to matter. A rumor is enough. If large holders start believing, if I stand, I might get dollars, not metal, then the squeeze psychology weakens. The bid for physical delivery softens, and paper selling pressure can dominate, fast. So when you combine higher margins, forced selling, with common delivery skepticism, weaken squeeze incentive, you can get a violent drop that looks like gravity turned on. That's why the fall from $121 to $103 can feel less like a normal retrace, and more like a pressure release valve. The margin call minute, what it looks like in real life. Let's dramatize it for a second. It's Tuesday, silver is ripping, your screen is green, you're long, you're not doing anything reckless, you think. Then the notice hits. Margins are raised, effective immediately. Your broker doesn't ask how bullish you feel. Your broker asks for cash. If you can't wire the difference by the deadline, the broker sells you out. Not next week. Not after lunch. Now. Multiply that across thousands of smaller accounts and a few overconfident funds, and you get this sequence. Selling begins, price dips, stops trigger, volatility spikes, margins rise again, more forced selling, and the drop feeds on itself. That's how a reset can be created without anyone pushing a big red button. It's the cascade. Clearinghouses. Why the red line is really about guarantees. A futures exchange is not just a marketplace, it's a promise network. Clearing members guarantee performance, they post capital, they contribute to default funds. That's what keeps the whole thing trusted. When price moves become extreme, the question is not philosophical, it's operational. Can every link in the chain survive a worst-case scenario? Today, at 120 warrants, the worst-case scenario gets uglier. If a meaningful chunk of longs demand delivery while price is exploding, shorts must either find metal, pay up for metal, or close at any price. That's where solvency shows up. Not as a headline, but as collateral calls. If the clearing system believes the tail risk is getting too large, it tightens the rules to slow the stampede. So the red line is less about silver is worth X, and more about the guarantee system can't absorb a sudden shift from paper trading to physical claiming. Why $121 felt terminal. Let's make the red line vivid. At lower prices, a big mismatch between paper and registered can exist for years because most participants treat futures as a trading arena. But at a certain price, the market attracts a different buyer, the buyer who wants certainty. Industrial users don't care about your candlesticks. They care about input continuity because a missing component can stop an entire production line. When silver runs hard, procurement teams start asking, should we lock supply before it's unlockable? And that's where paper and physical begin to divorce. The great divorce, paper versus physical. Here's the strategic shift. When futures feel unstable, big real-world buyers bypass the screen. Instead of buying a contract, they do something old school. They sign offtake deals directly with miners and refiners. They prepay. They reserve future output before it even leaves the ground. That changes the battlefield, because now the supply that would have eventually floated into exchange warehouses gets captured upstream. It's not a squeeze headline, it's a slow drain, and that's why you can see a strange split. Paper price drops, while physical availability tightens. If you've ever tried to source real metal during a stress event, you know, spreads widen, premiums persist, delivery times stretch, the screen price and the street price stop matching. The premium signal, one of the cleanest signals of divorce, is premium differences across venues. If Shanghai trades consistently above New York by $5–10, that suggests something simple. In one place, physical demand is willing to pay up. In another, paper selling pressure is dominating the print. That doesn't prove control. It proves segmentation. Two pools, two incentives. And if you are an industrial buyer, you don't argue with ideology. You pay the premium, or you risk the shutdown. What to watch next? The practical checklist. If $121 was the red line once, the market will create new red lines. So here's what you watch. Not opinions, data. Registered inventory trend. Is deliverable metal shrinking, stable, or rebuilding? Open interest into delivery months. Is paper exposure rising into a period when people might actually stand? Margin announcements. Do requirements jump rapidly during rallies? That's a clue to how the system handles stress. Delivery behavior. Are more contracts standing for delivery than normal? Are delivery notices accelerating? Premiums and lead times in the physical market. If premiums stay elevated while paper price falls, that's the divorce talking. Offtake news. Any signs of prepayment deals, long-term supply tie-ups, or direct sourcing by major manufacturers? The core thesis. Cleanly said. So let's say it plainly. At 120 yuan, silver wasn't just pricey. It threatened the comfort zone of a highly leveraged structure. And when structures get threatened, they don't debate. They apply risk controls. Those controls, margin hikes, position pressure, settlement uncertainty, can create a drop that feels engineered, even if it's simply the machine protecting its own solvency. The rally didn't die because silver suddenly became useless. It died because the system cannot tolerate a rush for physical at the wrong moment. If you're watching silver, don't just watch the chart, watch the plumbing. Because the next time you see a vertical run, the real question won't be, how high can it go? The real question will be, how close is the paper market to the physical wall? If you want, I'll do a follow-up where we map this exact red line framework onto a simple dashboard. Inventory, open interest, delivery counts, and premiums. So you can spot stress before the headline does. Like, subscribe, and comment. Do you think $121 was the red line, or just the first warning? This is for education and analysis, not financial advice. Markets carry risk, manage position size, and consult a qualified professional for personal decisions.